Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1338 and today's date is July 12th, 2017 and the title of the episode is The Central Banks Have Triggered the Collapse. The Setup is Complete. Let's get into the economic collapse financial news. Now, as we know, the real estate market, well, it's not going as well as the corporate media wants us to believe. And what is happening here is there are many individuals that are being pushed out of the market. Now, we're seeing that U.S. mortgage applications, they've tumbled by 7.4% in the prior week. This is the biggest drop since 2016. And the big driver was refis, which fell around 13%. And when we look at this, this is the biggest plunge since the taper tantrum. And this is what they're calling normalization. And if you really think about it, home prices, well, they're continually moving up. They're very, very high right now. We have stagnant wages. We have soaring rates. And they're trying to tell us that this is all normal and everything is going to be fine, which it is not. The opposite is happening right now. And for those individuals who are in retirement, who are entering retirement, who've been in retirement, well, it's becoming more and more difficult for them to make it through every single day. Even though they have pensions or they had investments and they thought, well, maybe I'll be getting some type of return on my investment. Maybe I'll be making some interest on my money. Well, a lot of them, they just don't have enough to survive because, as we can see, food prices are going up, healthcare is going up, everything is going up, and many of these individuals, they're on a fixed income. And what we're seeing right now is that more and more Americans, they're spending their golden years working. Almost 19% of people 65 or older were working at least part-time in the second quarter of 2017. Now, this is coming from the U.S. Jobs Report, which was released on Friday. And the age group's employment population ratio hasn't been higher in 55 years. Now, what's very interesting about this is that older Americans, they're working more, as those under 65, well, they're working less. And this is a trend that the BLS expects to continue, where they're saying by 2024, 36% of 65 to 69-year-olds will be active participants in the labor market. That's up 22% since 1994. And there are certain factors that are keeping old Americans in the workforce. One of the biggest ones is that they need money because they can't make it every single day. Their pensions, their fixed income, it is just not enough. Now, what's very interesting about all of this is that these government officials in states and the federal government, they thought, well, we can make things better. What we'll do is we'll pass the minimum wage requirement. We'll bring minimum wage maybe up to $15. That will solve everything. Everyone will be happy when this happens. Now, in the beginning, everyone said, this is a great idea. This is fantastic. But we need to remember, going back over time, we're never really realizing and fixing the problem. All we're doing is taking that existing problem and saying, okay, here's a Band-Aid fix. Here's a minimum wage increase. This doesn't fix anything because, you know, in 2, 3, 4, 5 years, you're going to have to do it again, and you're going to have to do it again. And what is happening is the entire plan to raise the minimum wage and to have people happy is completely backfiring. And we're seeing this because the University of Washington produced a rather extensive research report a few weeks ago, highlighting how the legislation was actually doing the exact opposite. What they're doing and what is happening right now is, as more and more people are getting paid more to do these minimum wage jobs, the corporations are saying this is too expensive. And what they've done is they've automated the tasks. So all those people who thought, wow, I'm going to be getting $15 an hour, now they have no job whatsoever. And out in Seattle, they've passed one of these laws where they said, listen, we're going to give $15 minimum wage, and it's going to make things a lot better. And what is happening here in the state is that people are losing their jobs. So the government there said, you know what, we're going to do one better. This will solve everything. We're going to tax the wealthy. And we're going to tax the total income above $250,000 for individuals and above $500,000 for married couples filing their taxes together. And this does sound great. Let's tax the wealthy. That's going to solve all the problems. Well, has it? Because let's go back in time here for a minute. Remember when the IRS was first being formed and they said, listen, we're only going to be taxing the wealthy. You rest of the people, you don't have to worry. The middle class, the lower class, no problem. The wealthy will pay for everything. This is how they suck you in. This is how they convince you that, yes, you're going to accept taxes. And of course, the wealthy were taxed. And then over time, it wasn't enough. They needed to tax the middle class. Then they needed to tax the lower class. The same thing is going to happen here. Out in Seattle, they're thinking, wow, this is going to bring in all this revenue. And you know what's going to happen. You know exactly what is going to happen. This revenue is not going to go to the proper areas. It will never be enough. And they're going to have to tax people at the $50,000 bracket up to $250,000. Then they're going to have to tax the people who making, whatever it is, $5,000 and up. And before you know it, everyone is taxed. Now, the BLS, they're reporting there's 11,000 individuals in Seattle with an earned annual income of at least $250,000. Do you really think this is going to be enough money? No, because we haven't solved the problem. Each state has too much debt. Each state is continually borrowing. The federal government is continually borrowing. We are working on borrowed money, or I should say currency. So this is not going to fix the problem whatsoever. Now we're seeing central banks all around the world, they're starting to raise the interest rates. The Bank of Canada, well, they raised their interest rates for the first time since 2010. And we're starting to see other countries, other central banks like the ECB, Bank of Japan. We see Canada, the Fed. Well, the Fed started to raise rates, and now we're seeing these banks, these central banks around the world saying, okay, we're going to cut stimulus. We're going to start raising rates. This is the time to do it. The economies are very strong. They can take it. We've done the stress test on the banks. Everything looks fantastic. Now, we've been looking at all the information, all the economic data, and we see the exact opposite happening. And we know what happens when you start raising rates in an economy that can't take it, a weak economy that never really recovered from any type of recession. The entire thing starts to break down. Now, what's very interesting is that the largest emerging market debt ETF from JP Morgan just suffered its largest outflows in history. Now, the question is, do they know something we don't? Well, it looks like Fed Chairman Janet Yellen, she was in front of Congress, and she has given a warning that the U.S. debt trajectory is unsustainable. Wait, what? I mean, we've been saying this for how long? Many people have been saying this for how long? Now, the Fed Chair, Janet Yellen, urged Congress to take into account the growth trajectory of the federal debt when making decisions about spending and taxation. She went on to say that lawmakers need to work toward achieving sustainability of this debt path over time. Now, let's think about this for a second. Over all these years where debt has been accumulating, especially from 2008 to the present day, where we doubled the amount of debt within, say, 8-9 years, not a word from the Fed, not a word from anyone. Everyone said it's fine. Now, all of a sudden, it's a problem. Now, why is that? And what's even worse is that the CBO, they've come out with this response. Now, remember, they've said nothing over the last 8 years. Now, this would be the time to say it. I mean, you don't wait. Let's take an individual where they already have 22 credit cards and they're all maxed out. You don't mention, hey, listen, you know what? Maybe you have a little bit too much debt. No, you tell them before you get there. Now, the CBO came out with this response. Now, this is where it gets crazy. They're saying there is a greater chance of a fiscal crisis. A large and continuously growing federal debt would increase the chance of a fiscal crisis in the United States. Specifically, investors might become less willing to finance federal borrowing unless they were compensated with high returns. If so, interest rates on federal debt would rise abruptly, dramatically increasing the cost of government borrowing. That increase would reduce the market value of outstanding government securities, and investors could lose money. The resulting losses for mutual funds, pension funds, insurance companies, banks, and other holders of government debt might be large enough to cause some financial institutions to fail, creating a fiscal crisis. I mean, think about what they're saying right now. They're saying this at a point where the Fed, the government, all those who've been doing this all along, knew that this was happening. I mean, you don't have to be a rocket scientist to figure this one out. And they went on to say, it is impossible for anyone to accurately predict whether or when such a fiscal crisis might occur in the United States. If a fiscal crisis occurred in the United States, policymakers would have only limited and unattractive options for responding. The government would need to undertake some combination of three approaches: restructure the debt, that is, seek to modify the contractual term of existing obligations, use monetary policy to raise inflation above expectations, or adopt large, abrupt spending cuts or tax increases. So we have the Fed here, who is now warning that the debt is unsustainable. We have the CBO now making this warning that there could be some type of fiscal crisis, which they're saying there is one coming. They already know this. And they're already telling you what they're going to do. You already know they're going to restructure the debt. You know there's going to be huge cuts. You know individuals who have pensions, investments in banks, savings, and everything else, you know those are going to be in jeopardy. This is the warning right now, because we know what has been done. We know the Fed was out there raising rates. We saw this back in 2005, all the way up to 2007, where all of a sudden the yield curve flattened and they said, okay, let's start lowering the rates. They just did the same thing, because Janet Yellen was out there saying, listen, I don't think we'll need to raise rates right at this point. Maybe later on, but it looks like we're good because the yield curve just flattened and they just triggered what they wanted. And this way now they're backing off. So this way people don't say, hey, you were continually raising rates and you brought down the economy. They did the same thing back in 2006 going into 2007. We're seeing the same exact thing happen. And now they're warning that there's a fiscal crisis headed our way. So when we look at this, we see that Janet Yellen, Mark Carney, Mario Draghi, well, they've all done this together. They created this gigantic problem. And now that they've weaponized short-term lending rates, the nukes can't be put back in their silos. They've already triggered the collapse. Why do you think everything is accelerating right now? I mean, think about it. We've been tracking it. We've been watching stores close. We've been watching everything. But in the last couple of months, since they started raising rates, things started to accelerate very, very quickly, where things were not getting better at all. All the economic sectors, the corporate tax receipts, the state tax receipts, the federal tax receipts, the corporate debt, the retail apocalypse, the GDP numbers. I mean, think about what you're seeing right now. All of this was brought about because of what they've been doing. They know what they're doing. They know they're triggering the crisis. And now they're going to pretend that they had nothing to do with this. It wasn't us. It must have been the government. They're the individuals that are spending. Remember, the central banks have no allegiance. When it's all said and done, they don't care if they're in the United States, China, Russia, or any other country. They have no allegiance. They just want to maintain their central banking system. And this is what they're about to do. They're getting ready to bring this whole thing down. And of course, the blame, as you can see, with the unsustainable debt, with the policies of the government, what they're going to have to do, they're all ready to point the finger. They're prepared and ready to do this. And this is what we see happening right now. This is why you need to get ready and prepared for what is about to happen. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.